over 5 consecutive months since the end of 2010, we're seeing inflation rising in Kenya, coming in at 9.2% in the month of March. The CBK recently at its MPC raised interest rates, but some are feeling that it's a little too late. What's your view?
Well, I think from my side, I've been arguing that the central bank should be raising rates for quite a little while. But I think if you spoke to the Central Bank of Kenya earlier this year, as I did, they themselves had a very clear thinking about how inflation trends would pan out. And although they thought inflation would rise, they still thought that it would come back within their target zone in the coming months. What's different now is that the rate of increase has been very much more rapid than they expected, and in fact even arguably than I expected at the start of this year. And I think therefore we are seeing that they have to make some difficult decisions and perhaps backtrack a little bit and work out how they're going to adjust monetary policy for going forward.
Some authorities still insist that inflation rising is a temporal phenomena, largely fueled by the rising oil price because of the political problems in North Africa and the Middle East, and would see some kind of equilibrium later on. What are your views, considering that, for instance, food constitutes 36% of the inflation basket? Can we take such a lax approach?
Yeah, well, I mean, that raises two interesting questions about African inflation. With food comprising such a large part of the basket, I mean, there is a fundamental question you have to ask underneath that about how effective monetary policy can be in that environment. Yes, you can raise rates, but they won't impact on food prices. Therefore, when you raise rates, when most African central banks raise rates, what they're trying to do is send a general signal to the market. Now, the Kenyan central bank's viewpoint is still very much that, yes, there have been problems with the harvests this year, but if you go across the country, there's pockets of bad harvests and good harvests, and they should equilibrate themselves out. In Tanzania, Uganda, we're also seeing that rains are quite good, and so once we're through the next few months, food prices still should start to come down, and that should help inflation subside. But it is really then a question of how much you think by raising rates, aggressively raising rates or not, they're sending a signal to the market that they are concerned about inflation. And probably I think at this current moment you would say that you're not too convinced that the Kenyan central bank is showing its full commitment to fighting inflation, unlike, say, the Ugandan central bank, which has raised rates significantly.
I mean, the rise in fuel prices has also exacerbated electricity costs. Despite what authorities are telling us, analysts say that we're going to see the cost of doing business rising in Kenya. In general, consumer prices are likely to rise in the region of 15 to 16% this year alone. For you, how serious is the situation, and how much of an impact is it going to have on growth?
Well, it will have an impact on growth, of that there's no doubt, and we will see growth rates perhaps not accelerating as much as we had. But even in Kenya, I don't think there's many economists who are forecasting that growth will fall back from the 4.5% recorded last year. It will still pick up, but it just won't pick up as much, so we need to bear that in mind. Generally, in terms of other, fuel price inflation, there is an issue across the whole of East Africa that until recently exchange rates have been very weak. A weak exchange rate at a time of rising food and fuel prices obviously puts upward pressure on it. At the same time, the pickup in growth is exacerbating the structural weaknesses of many of those economies. It's creating bottlenecks in those economies, which is all contributing to rising prices. I think the long-term issue is raising rates at least brings some currency stability perhaps, which then helps moderate some of the imported inflation effects for the central banks. And it'll be interesting to see if that argument increasingly gains traction in East Africa, especially somewhere in Kenya, where you've got a fiscal deficit, but you've also got a significant current account deficit. And the need to fund both those deficits will remain important for the government throughout 2011 and into 2012, which in Kenya's case is a pre-election year.
I'm glad you mentioned the fiscal deficit, because it also speaks to issues around reining in spending and debt management strategies ahead of the elections in 2012. The Kenyan debt is something like 47% of GDP. Is that a manageable situation? How else can they finance this debt?
It is a manageable situation. It's probably at the higher end of what we would expect. But if growth picks up in Kenya, and talking at the projections they have, say, in their recent IMF program of 6-7%, that would bring the deficit, the debt levels down to what we're looking at 40% of GDP going forward over a 3 to 5 year time horizon, which would be perfectly acceptable. I mean, on the debt overall, you have to think East Africa, and the whole of Africa, in fact, is facing a huge infrastructure problem. To confront that infrastructure problem, governments are going to have to borrow, and they have to work out an optimal borrowing strategy using the whole range of lenders out there that are available for them. That may include borrowing off the domestic market, but will also include borrowing from multilateral lenders such as the African Development or the World Bank, and also from bilateral partners, whether the new Chinese, Brazilian lenders or traditional partners such as the US or the European Union members. So there's a lot of complexity in this. I think in general you would say that the Kenyan government has a relatively well thought out strategy. It's trying to reduce the fiscal deficit, but it's also aware that it can't reduce the deficit too much in the run up to the elections, and with the increased expenditure requirements that are going to be pushed upon it by the constitutional changes that have been imposed or passed in August. So, you know, it's treading a delicate balancing act at the moment, needing to import, spend money on improving infrastructure, meeting the constitutional requirements, and trying to support growth, because that's crucial for getting out of its debt situation at the moment. So that's a difficult balancing act it will have to do.
Very, very briefly, give us a picture of what's happening in other East African Community member states. Uganda's had serious pre-election spending. That drove down the currency. Will things look better now that inflation is starting to creep in?
I think so. I mean, I think there's four factors which drove Ugandan shilling weakness: the political uncertainty, low interest rates, yes, the fiscal spending, and the fact that the current account deficit has been large in Uganda. My argument is that probably three out of four are now being improved. So the politics should improve now the elections are over. The fiscal deficit is being addressed, hopefully, and the IMF seemed much more positive when it was in Kampala the other day. And the interest rates have risen substantially in Uganda, so that should be. The current account deficit will remain large. Tanzania, in a way, is a few months ahead of Uganda. Its elections were in October last year, and it's making some progress in bringing its fiscal deficit down. Its interest rates are still a little bit behind and inflation is picking up, but it'd be interesting to see whether they also make more significant progress with fiscal consolidation going forward.